Hello, everyone. Good afternoon, and welcome to our Expert Series webinar, where we meet experts and explore some challenging topics that are front and center for our financial services and more generally our professional services audience. I'm your host, Priya Iyer. I will moderate the session for today, and we are coming to you live from our offices in New York City, just a few blocks away from the St. Patrick's Day Parade on Fifth Avenue. We have a large audience today joining us from the West Coast, so good morning to you folks, and some from across the Atlantic. Thank you very much for making time to join our webinar today and join this conversation with our experts. So let me introduce our topic for today. For today, we're going to focus on private equity firms and the challenges that they face in the deal life cycle. We will explore pitfalls and opportunities of technologies and what technologies are there, what do they have to offer, and discuss an optimal roadmap to build a tech-enabled PE firm. Before I introduce our experts for today, I want to invite our audience to participate in today's conversation. You will see a Q&A button on the bottom banner of your webinar screen. And if you click that, you can pose any question at any point during this conversation. So please feel free to join and post your questions, and I will make sure that your questions become part of our conversation and we talk about all of that. We also have some time at the end for purely Q&As, but I'll try and incorporate as many of your questions during the conversation. So with that, let me start by introducing our experts for today. Joining me is Nevin Raj. Nevin, say hi, who is co-founder and chief operating officer of Grata, a leading private company intelligence engine. Raj has worked with several PE firms as part of Grata and previously during his tenure at Riverside and McKinsey and Jefferies. And Nevin, I'm very excited to get into it with you today, to have you share some of your insights on the market and problems and the right way we can approach these to get to success. Also with me is Josh Webman, President and Chief Customer Officer of Concertiv, a leading procurement as a services firm for elite professional services organization. Josh, you work with several PE firms, and among these, with several of them, you specifically work with them on their market data and their technology challenges. And so I'd like to really start the conversation today with you. Just a week ago, I think I was talking to one of the CFOs of a mid-sized PE firm, and Joe was telling me, they started with great tools and technology and really a great operation. But in the past few years, they've had a huge growth spurt. They've grown a lot. And Joe was saying that, the challenge they're having is that in their growth, their technology infrastructure got left behind a little bit. And in some cases, it's not just not helping them, but it's beginning to hurt them. And I want to ask, what are you seeing in the landscape? What are you seeing in the PE firms? Please lay out that landscape a little bit.
Yeah, thanks, Priya. I think what you heard from that CFO, we're hearing in common across the industry. And in a lot of ways, it's the product of the success of a lot of these firms, where several years ago, they started as small, very lean operations, a relatively small number of deal professionals. And when they launched out of the box, they had the infrastructure in place that was a good fit for a small firm. And then again, a product of their success, they do good deals, acquire great companies, sell them, acquire additional great companies, have really successful fundraising. And then the organization grows, often following that fundraising. And then they now are taking a step back and realizing we have many more deal professionals than we previously had. Our other organizations in investor relations and marketing and portfolio optimization have grown too. we're not a little startup anymore in terms of the number of individuals that we have. We're now much larger and more complex. And the infrastructure requirements are different when you're a 40 to 60 person firm than when you're 15 to 20 at launch. And I think that's also coupled with the fact that while it's great to have the right data, the right technology at the outset, these are rapidly evolving spaces on the supplier side as well. So if you had something that looked great 10 years ago, it's almost certainly stale now. So, we found that firms have really had to adjust from being small and scrappy companies themselves, despite how big the deals that they were doing were, and have to address some of the additional complexities that just come with rapid growth.
Yeah. And Josh, what about the supplier landscape, the vendor landscape? They're growing too, aren't they?
I think that's one of the main challenges as well, which is that one of the great things about data and technology is that there's been an explosion in the number of vendors in a way that on the face of it, you'd think that ought to be great for the consumer. And in a lot of ways it is, because the very fact that if you bought something 10 years ago, it's stale, means that there's been tremendous progress, but it also means it can be difficult to make sure that you have the best in class solutions. So either from your existing providers, it's very likely that they've made a lot of development since you initially started working with them, and the marketplace has gotten much more crowded. So being able to identify who are the best in class providers today, who has the right roadmap that can grow with you at a firm, is really a challenge, particularly in private equity and particularly in the middle market, where it's seldom that you have a full-time professional and almost certainly not a full-time team of people who are staying abreast of the current landscape.
Mm-hmm, mm-hmm, mm-hmm. Very challenging indeed. Nevin, I want to step back a little bit and take a market perspective with you first. So when I compare PE firms to kind of other alternative asset managers, VCs and hedge funds, et cetera, we hear about them being, having very much of a tech forward approach. What about PE firms? How do you see the PE landscape, Nevin?
Priya, I think it's a great question. Josh was actually getting at this at the end of his last answer. Private equity is fundamentally such a different asset class because of the focus on the middle market. And as you mentioned, as you take hedge funds that have looked at public assets, there are about 5,000 tickers out there, to give you an idea of scale. VCs who invest in startups, there are about 100, 200,000 startups. But the middle market in the US alone is 6 to 10 million companies. And that level of scale is orders of magnitude higher than the scale you see in public markets and in venture markets. And therefore, the data problems are magnified orders of magnitudes higher. Now, the challenge here is actually less so of a depth problem and more so of a breadth problem. Because with public companies, you have typically decades for large established companies of structured SEC registered financials. Whereas with these 7 million private companies, you have bits and pieces of information, bits and pieces that your firm may have garnered over the last few years from looking at deals and teasers and sims and data rooms, or other data points you may have gleaned from the industry or outside in. Now, the other problem here is that it started to feel more competitive because more and more investors are looking at private markets. You have venture firms that are getting into growth equity and trying to find founder-run, family-run businesses that haven't taken any capital. You have hedge funds like Tiger and Co2 that are doing these private market deals. And then you have family offices and other alternative asset managers that are looking into the middle market. So the real challenge has been not just how do I get data and information, but how do I see this broad range of opportunities and how do I distill it down to the right ones and then get the right data about the companies I care about. So as we get deeper into this topic, we're going to talk more about how you can use technology to solve that identification problem, and then the data problem which comes after identification, which tends to be which is particularly amplified in middle market private equity.
Mm-hmm, mm-hmm, mm-hmm. Nevin, how are PE firms approaching this challenge of, what Josh talked about? There's growth, there's technology infrastructure, exploding vendor land. There's all of these things. You laid out the market landscape for us, the market challenge of the PE firm, but what about this internal challenge that PE firms are going through? How are they approaching this?
Yeah, I like to think about it from two lenses. The first lens is the stage of the deal, and the second lens is where is the data coming from. So let's start with the first one. Every high functioning PE firm has 2 to 3 different groups, and that is business development, which is top of funnel. Where are they getting deals and first meeting and interacting with companies? The deal teams, the ones who actually execute the deals, and then portfolio operations, which takes the deal post acquisition and works with the companies to create value. And there is a gap in information across each of those 3 teams, where they tend to operate in somewhat of a silo, and then there's a loss of information. So the first part is really getting the transfer of information between the different teams to be really smooth, such that the whole firm operates at a higher level. What you learn from your portfolio or what you learn from a deal that actually died could be really valuable for business development, and vice versa. What your business development team is learning from all the conversations they're having can really inform active diligence as well as your existing portfolio, and those need to play together. So that's one. And there are tools and systems, starting with, for example, CRM, that can really help you do that. The second one is, where is this data coming from? Is it coming from inside out or outside in? Inside out being, is it coming from the company itself, from your knowledge, or are you finding it from other sources? And there's oftentimes a disconnect between those two. All the data that you get inside out tends to live in PDFs, Excel models, emails. The data you get outside in tends to sit in a database, tends to sit in some other portal. And the combination and the marrying of those two can be critical to success.
Yeah.
Very much.
I might piggyback just quickly on that last point, which is, we saw the trend that we saw several years ago was firms understanding the importance of adoption of a CRM. And then it was difficult for them to get engagement from their internal teams because of the exact data issues that you're describing, Nevin. So one of the major trends we've seen is where maturation and adoption of CRM has peaked or continues to increase is enriching it with data. So it's not just having the system itself, but marrying your own internally gathered and external data. But completely spot on, I think.
Absolutely. And then what's you're right, the maturation of CRM, I think, is at all-time highs, and it's only going up. You never hear anyone say we're going to move off of CRM.
Yes.
That's the way of really
spreadsheets.
Professionalizing. Yeah, that would be a step back. I think that the next step that we see is, now once you have a CRM, once you have a process in place, the processes then tend to be either manual, inefficient, or undifferentiated. Because what everyone's doing is they put in the CRM and then they take the same approach of still manually collecting information. So the average, let's just take business development, for example, the average BD process involves a very heavy lift in finding companies, researching each company individually, going to its website, going to LinkedIn, going to a database to pull contacts, validating those contacts, putting those contacts in your CRM. There are many, many steps. Whereas you take public markets as an analogy, you find a ticker you like, you can go to your broker, or you can go to your trading platform and place a trade. It's very easy to get that next step of going towards investing in that company. Whereas here, there are so many steps in private equity that happen just to find and to get good data on companies.
Yeah.
The second part is that this then plays into diligence. And we've seen a lot of prospects and customers that we talk to who have this process that they're used to, this very manual, putting in a lot of hard work, and that plays through into diligence, where they're okay with data coming from different sources. Once again, data being siloed from business development, in diligence, and portfolio operations. There's a whole culture around, we're going to put in these 60 to 100-hour work weeks, especially when we're on a live deal. And there's more technology that's making that easier, so that you can either get to a decision faster or get deeper on a deal and still put in those hours.
Yeah. So Josh, I want to I want to share a stat that you had with our audience, which I find fascinating. Concertiv's research shows that on average, PE firms spend $34,000 per professional per year on technology. That's not a small number. And I'm guessing that today's inflation is just bumping the numbers up even more. Can you help us understand this from a CFO's perspective?
Yeah, I think what we hear from CFOs is, one, that number rings true for them. And second, that it doesn't show any signs of abating. So that number, we expect not just inflation driving it, but adoption of additional tools and services will drive that over time. I'll say one thing, and I think we hear this from CFOs as well, as not all spend is bad spend. So that is not just a cost of doing business, but can be revenue generating spend when handled correctly, when managed correctly, and when you're being diligent about what you're spending money on. But yeah. I think it's been driven by, that is the response, the manifestation of the response to some of the challenges that Nevin was describing of, okay, how do we have all these platforms? How do we enrich these platforms? How do we get them to speak to each other? And a point that I raised earlier around the explosion of the number of vendors. So I think there is a vast network of companies who've identified these pain points and have tried to find their own solutions. So the challenge becomes, okay, if money were no object, we'd buy everything. But that actually, in some ways, compounds the problem, because then you have additional data sources. Sometimes they compete with one another. There's no holy grail, et cetera. So the real question to CFOs is, how do I ensure that we're getting ROI on what we spend? How are our teams really validating that the data that they're getting is accurate, it's actionable, and what they're using is best in class? And then the important part is also, how do we take what we're getting from a data perspective, and it may be data sources that our competitors are purchasing as well, and add our own secret sauce to make sure that the insights that we're generating from that data are differentiated and actionable. And I think what we find is that the CFOs who are really plugged into their organizations, who are talking to the deal teams, but to Nevin's point, also talking to business development, portfolio optimization teams, and also IR, that they're getting an understanding of, are we really working with the right vendors, and are we getting the most out of it?
Yeah, exactly. As you said, it's not that the spend is by itself is not a problem, but when the spend happens and the technology is not helping, it's right, coming in the way, that's when it is a problem. So
yeah, and I think one other thing, and Priya, to one of your earlier questions, what are some of the challenges as firms have grown, is that it actually requires, it can be a full-time job for maybe many people to stay on top of this growing portfolio of data and technology, or you'll continue, your spend will snowball, and that's when you get into the situations where you say, we're spending a lot of money, but also we're not getting what we need. We've been using the same provider for many years, and we're just on autopilot, and that's when companies feel like they're not getting payback on their spend.
Yeah, well said, Josh. I'd like to progress our conversation maybe to the next step, and as we think about this technology roadmap, I think it's kind of important to align it with the business process, right? And Nevin, you've been talking about the deal life cycle, and I hear about many PE firms talk about this approach to deals, on the one side, having a transactional approach to it, on the other side, a more strategic approach. So the kinds of things you're talking about, Nevin, which is, identifying deals, reaching out to them, nurturing them over a period of time. And of course, there's the closing and the due diligence and all of that. Nevin, how can technology help us accelerate from this more transactional model to maybe a more strategic model? Can you kind of tell us more about that?
Yeah, let's actually start off with talking about the different stages and how the strategic model, as you mentioned, plays into the stage-based view of private equity. And it all starts with identification. So what I want to do is I want to remove the world of all your deals come from relationships and bankers. The way the industry is moving is this omni-channel deal flow, where you're going to get some deals from bankers, you get some deals from relationships, but you have to generate your own deals.
Yeah.
And this is the arm of identification of proprietary, we call it proprietary deal sourcing. That's the term used in the industry. And that means really quite simply a private equity firm doing direct outreach to founders and business owners about an investment or acquisition opportunity. And in proprietary sourcing, this is not new. A lot of firms are doing this and more are catching up.
Yeah.
It's been done in a few different ways. The first way, and this is called one of the oldest tricks in the book, and this is actually where the venture capital world started, was funding-based proprietary sourcing, meaning they would track, and they do track, when a company has received a round of funding. So let's say you're a Series B stage fund, you do mid to late stage deals, you track the seed and the Series A deals. So you see anytime a deal is done, there are sister funds who are portfolios, but portfolios one stage earlier than you. You track it, you have data, and typically you would implement PitchBook. That's been the industry leader, PitchBook. Others have tried Crunchbase, and there are a couple others. PitchBook is a leader here. And you have a funding-based approach. You track stages of company growth, and then you reach out at the time. Usually you'll predict maybe a funding event happens, so you reach out to them 6 months later, 12 months later, assuming that the next funding event will happen on an 12 to 18 month cycle. Now, the second way this evolved was going from funding to event-based. A lot of people went to conferences, started going to events, started really networking, because the world we knew was a relationship-based world. And what's helped in that world is a platform called SourceScrub that's really providing conference lists. Now, the way this is evolving and where we see the market going is to thematic sourcing, where there are a lot of investors in private markets. It's getting more competitive, and founders, to engage with an investor, are expecting someone to come in and be really knowledgeable about their sector. No one wants to talk to an investor who doesn't know their business, doesn't know their space, is asking basic 101 questions. They think, hey, you should do your homework, you should know my space. And so to build that trust, investors are doing a lot of research up front. They're doing their GLG calls, they're doing their industry knowledge up front, and coming up with a thematic campaign. So for example, a healthcare investor may say, instead of in the past saying, let's look at healthcare deals, they're now saying, let's look at chiropractic clinics, because we think that people are going to have back problems because we're all looking at our phones every day. And let's look at chiropractic clinics in non-urban areas that provide these other massage therapy services. That's a thematic approach. Now that's given you a niche that you can be smart about, and you can know better, and you can find companies. And you typically go through a campaign, and you need real search technology to power this. And our company Grata is an example of such technology that powers this new way of thematic sourcing that a lot of investors are moving to. But what you do here is you come up with a thesis, you find a set of opportunities, you launch a campaign, and then you iterate, and then you find the next theme, and you find the next theme, and it's a cycle that flows in. And this is one of 3 ways that proprietary sourcing is done. The second thing in the identification stage, outside of discovery, is actually what we call the vetting stage. Or said differently, this is where you're doing the research and you're trying to understand if that company is really qualified to talk to you. The way this has been done in the past has been through firmographics. Even though in the company's industry, maybe you get their head count. Once again, that funding data you get from PitchBook. Sometimes you'll get a revenue estimate. Who knows if you can trust that number? What's changing now is this is evolving to industry-specific outside-in data. And the tech industry, for example, has adopted data sources like web traffic. A company called SimilarWeb provides you with insights as to how many visitors and unique visitors a company is getting, which can be a proxy of traction. There are companies like App Annie providing you with app download data for the mobile app world. Once again, that sits in tech. In consumer, there's credit card data. A company called Second Measure aggregates this from credit card providers. Online reviews this is for consumer tech. G2 Crowd does this. Crimson Hexagon, which was recently acquired by Sprinkler. There's also NetBase. And then in healthcare, for example, there's claims data. There's Medicare data from Medicare.gov. So each industry has its own set of industry-specific data that once you've identified companies, help you tell the good from the bad and the better from the best. So this is where the industry is going, at least for identification of companies. And there's been a lot of evolution in these systems and in these technologies.
Great.
Evan, you brought to life some of what we were talking about before around vendor explosion. It can be tough to wrap your head around all of the different sources, identify which ones are best in class, and assemble the portfolio of what works best for you.
Yeah,
Absolutely. That's why it's knowing what sectors do you care about,
Yep.
what's your investment style, what's your strategy, because you're right, there's hundreds of different companies out there. So once you've narrowed it down, then it becomes much easier to figure out the right tools for you.
so Nevin, you talked about identification, and what from there? How do I use technology for the outreach portion of this?
That's right. That's a key component here in private markets. It's how you actually get in touch with a business. And I think the key here is that deals don't get done overnight. We all know this, but when you're working on bank deals, there's a process. The deal is going to get done in 3 months. There are deadlines. With proprietary deals, there are no deadlines. It could be 1 month, 1 year, or a decade. And there are technologies out there to help us navigate this, because this is hard. The key technologies that have come out are ones that help with outreach automation. And this class of tools, there's SalesLoft, there's Outreach.io, Reply, and there are others that offer this as part of a broader suite of even contact information. And what they do is they help you automate multi-channel sequences where you're able to get 6 to 8 touches, for example, in a campaign on a founder in some period of time. And that could be, you send an initial email with an introduction, you follow up with some industry research, you follow up a third time, checking in, saying hello. Maybe you then connect with them on LinkedIn, you give them a call, you send them a text, but there are all these different ways to get in touch. And these platforms help you build that cadence, because it's easy to forget. You're on a deal, something else spikes, someone else responds, you go to a conference, you have a meeting, you then forget to follow up. These help you keep the drumbeat. And then there's additional relationship intelligence that's coming up. And we think of relationship intelligence in 3 subcategories. One is trigger-based. Did something change with the company that you're looking at and your target? And once again, you go back to, we talked about in the identification stage, these different data sources and technologies that help you identify companies. They also tend to have data points that show you, as markets change, when there are triggers and changes in your company. Have they raised funding? Have they changed web traffic? Have they changed, going back to thematic, have they changed their focus as a business and their business model? That's one way to reignite a conversation in the outreach stage. The other way is activity-based. So you may reach out to a company because something changed with you. Maybe you talked to them a year ago and it's been a year. You haven't chatted in a year. Or maybe there's something that changed with your firm. You just raised a new fund that would be the appropriate size for the company you spoke with. And then finally, there's a networking-based approach to outreach, which is, did you find a mutual connection as your way in? Do you share the same lawyer, the same banker? Do you go to the same Little League baseball games? Are you going to the same events? That combination is what signifies omni-channel outreach. It's not just one email and you leave. The most successful firms we've seen are taking this holistic approach and really thinking about this from many different angles.
Right. And I think, Nevin, that in order to do that successfully, I think you can't just have one of those workflows. And you described several ways where you must marry external factors, external signals with changes in information from your own firm. So it's all well and good to know a bit about the company, but if you don't have some of that network mapping, relationship mapping, then it's hard to identify actually what is the conversation starter. To have you filter away from the top of everybody else who's also reading those same press releases and identifying the same activity changes at the companies themselves.
Mm-hmm, mm-hmm.
Exactly.
Yeah. Josh, to steal Nevin's sentence there, deals don't get done overnight, do they?
Correct.
It takes a long time. And so we've done the sourcing, we've identified them, we've done our outreach, maybe we've gathered information, we've gathered a bunch of information, but there is this big, so it's that nurturing phase, and then it is the closing as well, right? Like the due diligence and all of that. Talk us through that phase and
Sure.
what's required there. What do we need to do?
Well, it's actually, I smile here when you talk about the nurturing phase in a conversation about data and technology. Nurture sounds so human. It's
Yes.
about relationship building, building confidence, building trust. What is that doing in a conversation about data and technology?
In
And
the
I think,
pandemic world.
yeah, exactly, especially over Zoom. And I think one of the main ways is to be as an investor, well prepared and well informed when you are nurturing those relationships. When there is proprietary deal sourcing, it's very common that you're actually not the only firm going after that entity. So the way to differentiate is to know more about the space, be ahead of or equal to the entrepreneurs and knowing about the landscape. And I think a way, and Nevin touched on this, is being on top of signals. So everyone is consuming a lot of the same data and information. What are you doing on a proprietary basis internally so that when you consume that data, a light bulb goes off that says, hey, here's the right time to reach back out to that entrepreneur, talk to them about what's changed, and talk to them about how you're well informed. And that all sounds great in theory, but let's go back to what we were talking about at the outset around middle market firms. That type of technology is tough to have out of the box. So, and a middle market firm would say, hey, that's all well and good, but we don't have armies of engineers. We don't have teams of data scientists. What do we do? I think the first thing that we're seeing is, one, even in the middle market, firms are beginning to invest in having some of those dedicated technical resources internally who can be working on data science, elevating actionable insights to the deal teams. And second, I think this is another use case for CRM, which is that this goes beyond just having a contacts database and a little bit of pipeline management, but let's use that as a data container for all these sources of data, external or internal, and have that not just deliver information that I can find if I search for it, but elevate it to the end user in a much more proactive way. And then you use that to then do the human part, which is to reach out, start building that trust and building the relationships, but come to the table or come to the Zoom call, really well informed about the entrepreneur, the industry, and what's changing.
Yeah.
And I think that carries over to the diligence side of things too, because
Totally.
ultimately you then need to try to close the deal. And as things take many months, or particularly at small to medium sized companies, things can change. So there are new entrants, there are macro changes, and if all the information that you're using is stale, then by the time you finally get to sign the term sheet, you want to make sure that your investment thesis is still relevant or still accurate, or this company still checks all the boxes. So maybe you refresh those expert network calls, you take a look back at the notes that you were taking and adding into your CRM many months ago, and make sure they're all correct and relevant, or refresh as necessary.
Yeah. So you both have told us about what needs to happen. Okay. So can we talk a little bit about how we make this happen? How do I get this done? I'm a busy CFO, COO, CTO. Give us a roadmap, Josh. Give
Sure.
the audience a roadmap. Where do I start? Lay out the steps.
Yeah. Well, I think the way you asked the question, I think, is actually really great, because the way you start is by starting. And I think that this can sound so daunting. And I think that's one of the trade-offs with opportunity, which is, yeah, this all sounds great, but can we actually do it? So I think the first thing to remember is that none of this will happen overnight. The second thing is that, and this is good news, is that we don't think it's controversial internally or institutionally to get buy-in for this type of dramatic change. All the insights that we're surfacing on this call are what we've gleaned from actually talking to people at these firms. We talk to the principals and the managing directors and the CFOs and COOs, and it's simply just not that controversial. So I think the first step is trying to solidify that institutional buy-in that data and technology can transform the way that private equity firms work. It can be a way to differentiate firms in what's becoming a more crowded landscape with more competition for deals. And that requires having those conversations internally. I think an important part of this, to make this very concrete, and I now sound like a broken record, but it's identify all the relevant stakeholders. I think there's a temptation to have these conversations be siloed, but precisely the point is to have better cooperation. So it's reaching out to your IR and marketing teams and hearing about what their data pain points are around collecting information from the portfolio companies and norming it. And then also getting those same specifications, requirements, and pain points from the deal teams. And you'd be surprised, I think, at two things. One, how common some of these requirements and pain points are at different parts of the organization, including the finance function. And two, the importance that companies see of being collaborative. And I think it's a response to the observations many of these firms have had internally, is that this was all well, and we didn't need any of this when there were 20 of us in one office. But now where, we've had an explosion, the number of people, the complexity, people are remote, et cetera, we need to do something about it. So first is take the time to do the strategic thinking, and don't be daunted by the size of the product. Two, sketch out the roadmap with the understanding that this is a constant transformation. This is not the type of project where you'll say, okay, we're now a tech-driven private equity firm. There will be many phases of it. It's not going to get done overnight. But it's important to define success and milestones along the way. And that's important because it's great to get institutional buy-in at the outset, but if you aren't tracking your progress over time and saying, here is what we plan to do, here we did it, then you won't have the continued institutional buy-in. And we find that individuals who say, I'm doing a great job, I think, and I'm so in the weeds, most of the organization won't be in the weeds that way. So I know people don't want to toot their own horns, but being vocal about, looking back at the requirements and specifications you've sussed out at the outset, showing how you're achieving against them, we think is critical. And then here's a piece that Concertiv spends a lot of time thinking about with our CFO and COO clients, is budget and ROI. And maybe it sounds simple, but most of the time for firms, the decision is not, at this stage at least, let's hire huge armies of people, but it's a lot around vendor sourcing. Who are the technology partners we're going to work with? And that's software and services. Who are the data providers that we're going to work with? And if you must get concrete early on about what is it going to cost to work with these vendors? What's the total cost of ownership? And what does this look like over the long term? Because seldom are these vendor relationships 1 or 2 year partnerships. You want to be thinking about it long term. And then you need to figure out the payback and ROI on that spend to help you make that assessment and confirm, what do you build and what do you buy?
And even to jump off of what Josh is saying, which is a really good point around, a lot of these are long-term relationships. And because you are focused on getting deals done and your expertise is in finance and deal making, we haven't seen any firms with more than 3 or 4 technologists. And even that's usually a stretch. At most, we've seen maybe a data scientist, maybe an engineer, integrating with different partners. If you think of your partners as vendors, it's going to be you getting something from them and using it. But if you work with them as partners, remember, if they're bringing their product to you, a technology, a data, they're probably talking to 20 other firms that look like you. You can learn from them. And if you really partner with them, you can get the most out of them. And therefore that ROI can be a lot higher.
Yeah, I think that last point's interesting because, we've talked a bit about here the number of vendors exploding, but I think one thing that has been to the customer's benefit is that the pace of product development at these data and technology providers is inspiring, honestly. Every time we have a conversation around a contract, or we here at Concertiv spend a lot of time getting to know the products intimately. Every time we talk to a new provider, there has been a lot of advancement, and that comes from their customers pushing them. So I would say develop those relationships, provide the feedback. Trust me, the data providers and technology providers would love to hear the feedback, and it inures to your benefit down the road too. I think it's a spot on point, Nevin.
How can PE firms really benchmark? There are kind of a couple of points you've talked about, the vendor landscaping and understanding that, but what about kind of benchmarking themselves and knowing where they need to progress and where they're good? Any thoughts on that from both of you?
Yeah, I can start, which is that this has been a learning for us over the last few years, is that despite the intense competition for deals, despite how intense some of the work here can be, we find that from an operational perspective, firms are actually very willing to collaborate and share best practices. So we think there's a lot of value in developing the networks of your peers who work at other firms. Of course, there will always be secret sauce that no one wants to share, which is important too. Everyone needs to remain, differentiated. But we found that companies are very willing to talk to one another, without providing confidential information, but saying, here's what's worked. This is, we talked a bit about what's the roadmap to execute on this. We find CFOs and COOs are willing to share the ways that they were able to build institutional buy-in to work on these transformational projects.
Mm-hmm. Thank you. So I want to incorporate some of the questions from our audience, a few things coming in. So the first question is about, we touched a little bit about hedge funds and VC firms and being technology forward. And our audience would like to know, can you provide a few more examples of data and technology innovation adopted by hedge funds that you think could be applicable to private equity firms? Either of you?
Sure.
Yeah, sure.
I can. Yeah, go ahead, Nevin.
Yeah, I could chat about that a little more. When I was chatting about different technologies at the discovery and identification phase, we talked about industry-specific technologies, and that's where the hedge fund world coined the term alternative data. And the reason they coined that term is because it was data that was not SEC-based financial data. Mm-hmm. And so you have Thomson, FactSet, Bloomberg, S&P really captured that financial data. Then the alt data world came about. And the alt data world had a few different types of sources. One is you have your aggregation of public sources. And so people will generally say that's web scraping, publicly accessed information. And then you have your other data sources, which may be contributory data. I never like the word proprietary because public data can also be proprietary just based on how you process it. That's different. But then you have your other data sources that are more contributory. You tend to see that the more niche, traditionally proprietary contributory data tends to be more specific and relevant to a particular industry. Take, for example, credit card transaction data. All data, no data is fully has full coverage. Right? Even your credit card data it's the sample, it's a panel, it's going to cover a subset. That's really only good for consumer businesses, and particularly consumer businesses that sell directly to a customer. So if you're selling through retail channels like Walmart and let's say other in brick and mortar stores, then that transaction data only tells you that the customer shopped at the store, not what they bought. Then you need Nielsen or IRI data. And so you have to really understand, going back to what are your themes, what are your sleeves, that will determine the niche data sources that will be valuable to you. But there are some cross-cutting ones that can provide you with, for example, headcount data and general growth metrics, funding and firmographics. So it really comes down to thinking about the framework and understanding what is going to be broadly applicable to all your investments, and then what's most important to you and where do you want to double down. So I know that's more of a general answer, but hopefully that helps at least think about this. And Josh could probably chat a little bit more about how he's seen procurement decisions made.
Yeah, and I think that you're right, particularly on the alt data side, which is that this is relatively mature now in the hedge fund world, and we're just starting to see it permeate into the PE world. Why is that? The answer is that you can buy all the data you want, but if you aren't ready to analyze it or do anything with it, then it's not of value. So, the types of analysis that the PE firms were well equipped to do was predicated on the type of data that they were consuming. They weren't consuming this data. They didn't have the right professional specialization internally to do the work. So what we've, Nevin made the point earlier about not having some of the, data science specialization at these private equity firms. It's actually not true on the hedge fund side. So, they are in our view, and this is painting with broad strokes across PE, a few years behind when it comes to having the folks internally who can ingest that data, incorporate it into the models that the hedge funds are using to make those investment decisions, and actually make it actionable. But we are seeing perhaps slowly, or slowly is not the right word, but perhaps unevenly, seeing the type of investment at private equity firms in terms of having the people who can ingest this data, do work on it, make it digestible to other people at the firm, and then actually turn it into investment decisions the same way that they've had models for years that were running off, fundamental company data. So there is a little bit of a lag, which is, companies we've seen this where we've coordinated demos with a PE firm with a great alt data provider. The PE firm sits there really excited about what it could be, and then realizes, wait, we don't even have a way to consume any of this information. And I think that's an area too, where we've talked a little bit here about data and technology as separate. They're really not. And I think that the line is blurring, and I would expect to see over the next few years a little bit of a shift in terms of the skill set that firms are recruiting for. And I think that that's becoming tech driven is not just about the products you buy, but about the people that you have internally and what their skill sets are.
Yeah, very well said. Yeah, that's a great point. So one more question from our audience. So we've talked a little bit about consuming data and this thing about everybody consumes the same data. And the question is, what are the ways PE firms can differentiate from one another if they continue to purchase the exact same data and technology solutions as all their other competitors?
Yeah, we hear that one a lot as we talk to people. They're like, okay, this is cool and interesting, but what happens when everyone uses you? Where do we go next? Are we going to have that same edge? We think about this in two ways. The first way is, yes, that it is true that as something gets adopted and everyone has it, that information edge goes away. So there's an advantage to being a first mover for any technology. But there are some caveats to that. The first is, and I talked about earlier, the combination of internal and external data. You as a firm know things that no one else knows because of your unique experiences. You have X analysts, Y associates, Z VPs. You have your team out there talking to companies, doing diligence, talking to bankers, opening up data rooms. The more you can leverage what you know and combine that with what you buy, the smarter you can become and the more differentiated you can become. So that's one way I've seen firms do it really well, and the best really marry those two. The second one is developing expertise, because there are 7 million businesses out there. You don't need to acquire all 7 million. You need to find the few places that you're good at and get really good at them and build the expertise. So the firms that we've seen do a really good job aren't necessarily, they could still be generalist investors, but they build expertise in various sleeves, theses, themes as they call them, and then become really smart in the theme, understand the valuation multiples, what's a fair deal, what's not, what a good company looks like, what are the metrics they have to track, and then procure the right data and build the right processes to be able to make really good deals in the areas of expertise, which are constantly changing and evolving as their view of the macroeconomic landscape also evolves.
Yeah. I would say this is also an interesting one where we may see PE learn from hedge, but we haven't seen it yet, is that many hedge funds will find when they identify a great source, they will pay a premium to make it exclusive. So we'll see if that becomes something that happens in the PE world. We're not seeing it much. But this objection is one that, particularly at Concertiv, we hear all the time because we give advice to lots of different firms about data that they ought to procure, and they say, well, if you're giving us this advice, everyone's going to be buying the same stuff. Our view on it, and Nevin, I think, talked about this, is give yourself a little bit more credit. It's great. Everyone's consuming all this data, but it's not just he with the best data wins. It's what are you going to do with it? How are you going to commingle it with your own data, your own expertise, your own processes, your own relationships? And this is as much as we're all data nerds here, I think it's just one of the ingredients. I think firms will very easily find ways to differentiate themselves, even if they're using many of the same tools and data sources.
Yeah, that's a great point. I can't tell you how many times you've seen someone look at the same exact data point and reach two different conclusions.
Oh, certainly. Yeah.
So maybe this is a broader question that someone's getting into. You talked a lot about these data and technology solutions being important for PE deal teams. But could you discuss a bit more about the areas of efficiency across other parts of the PE organization? Josh, maybe you can take the first one on this.
Yeah, I can start. And I think that what we're seeing this most acutely is with investor relations teams and marketing teams, because their LPs are asking really tough questions. They are really demanding when it comes to talking about performance, learning about what the themes are that the deal teams have, learning about successes, learning about performance. And we find that that was an area of the business that was a bit underserved in terms of data and technology, because there was so much emphasis on the deal teams. But the IR teams are critical. They're revenue generators for the firm in terms of working on fundraising. So we found that's an area not just that needed a little bit of TLC on the data and technology side, but also should be brought into the same ecosystem when companies are making technology procurement decisions. It's great to have a deal pipeline tool or a CRM tool that works for the deal team, but it also ought to speak to IR. It also ought to speak to Nevin's point before, to the portfolio optimization teams, to the BD teams, so that you're really covering the whole life cycle, hopefully with as few technologies as possible to minimize some of the patchwork nature or integration needs. And we're seeing firms really realize that they ought to be looking at solutions that cover the enterprise and investing accordingly.
Thank you. Nevin, there's a question specifically addressed to you. And it says, you've used this term middle market several times in what you've talked about. How large is the middle market really, and what is the minimum threshold at which a firm is considered middle market? That's the question to you. Are the pain points and solutions you describe also applicable for the smaller firms, earlier stage PE firms?
Yeah. Question, because this definition is debated a lot. We use it very broadly to define not public markets and not startups and anything in between. So our definition does include SMBs. We actually see a lot of technology adopted by search funds and independent sponsors. It's by a force of need. When you're a 1-person or 2-person shop trying to do deals, trying to compete with big time private equity firms, you have to be hyper efficient. And so a lot of innovation is happening there. And those are some of the smaller deals, all the way up to the large mega funds that are doing private, pre-IPO type deals. So our definition of middle market is quite broad. It can range from $1 million in EBITDA to 500 million in EBITDA.
Okay, thank you. Josh, maybe this one is geared towards what you talked towards the end. We talked about, a roadmap for how do I get started? How do I get this done? And the question is, our teams are already overloaded. And maybe I'll paraphrase it, the CFO, the COO, the CTO, et cetera, their calendars are blocked. They're taking tiny slices of their time to do all the things that they're doing. In that landscape, how do you expect us to do the things you talked about, which the question is, how do we assess vendor landscape? How do we do benchmarking? How do we go about doing the procurement and the implementation of the right tech stack
Right.
I don't know if you have more insights to add to that.
Yeah, and this
Where
is
can they
this
get
is
the help?
yeah, I think this is near and dear to us because there are firms out there. Concertiv is one of them that focuses on these types of projects. And I think just in the way that when you're thinking about data and technology, there's an openness to using third-party data and technology providers. There are outsourced consultants, there are specialists who can serve as extensions of internal teams to help get these projects done. Some of this can boil down. One of the reasons we hear why firms don't execute on these initiatives is exactly what you're describing, Priya, which is I'm busy enough already. How am I going to carve out the time? And the answer does not have to be going to a big four firm or a major consultancy. There are firms that specialize in this type of digital transformation specifically for financial services firms where the needs are unique. And we've worked personally here at Concertiv on a few of these projects as well to make them bite-sized. So, when we talked about the roadmap, one of the things we said is that this is evergreen, but you need to figure out what are the key phases, what are the milestones that we can set for ourselves so that we're measuring success. And it is possible to get help. And because oftentimes a firm will look internally and say, who actually, even at our firm, would be the right person to do it if we did have the time? And oftentimes that professional is not there internally. So it's not new to firms to use consultants on deals. It's not new for firms to use experts on deals. And we think for these operational matters, it pays to work with experts as well.
Okay, well, I want to thank our experts for sharing all of this wonderful wisdom with us. And also I want to thank our audience for being so patient. I actually did not get to every question that we had, but we're unfortunately out of time. But here's a promise. We will get every question that you have answered and back to you. So we'll reach back out to you and make sure you get that. Also, a recording of today's webinar will be available, and we'll make sure that all the attendees and all the registrants have access to that. So with that, I want to again thank you, Josh, and thank you, Nevin, for being such great panelists and experts for us on our expert series. And goodbye to our audience, and we'll be back with another exciting version of this in the not too distant future. So this is Priya signing off. Bye, everyone.
Thank you, Priya. Thanks, Nevin.
Bye, everyone. Thanks, Priya.
Yeah.